Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active, passive, been working in the industry for decades, well, this is the YouTube show and podcast that we created just for you that covers all the latest research reports, data, articles, and then some original opinions from the Gray Capital team. Really to make sure that you are up to date with the best information to make really smart decisions, whether that's investing or your career in the multifamily industry. Again, we're covering multifamily, real estate, and the economy. Joined by co-host Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. We've got some interesting articles and reports from Apartment List Berkadia, the Wisconsin Institute for Law and Liberty, and The Atlantic. Again, we're also just going to be giving you our opinion on what we think about the market and where things are going. All right. Let's get into it. All right, bringing it back in on the Gray Report. Matt, Merry Christmas, Happy Holidays. Yeah. We had a good weekend this last. Or do you have a good time relaxing with the fam?
Yeah, very very busy. My brother said, my twin brother said, it feels like kind of like a robot going here, but
yep.
There's room for humanity.
We try to find the humanity in the smallest things.
That's right.
Well, we got the new year coming up, but we're not stopping here. Great Capital. We got stuff going on, exciting things. You know, always trying to strike a good balance, but I don't know. Can't keep us away. It's too exciting.
I know. I do think like, man, this year's kind of blended into the next. We there's no stopping point for us.
No.
It's just start the next paragraph. Let's keep going.
Why not? And Matt, on that, and I think we're gonna be having like a press release and a video. We were just doing some like year-end roundup for Gray Capital and a little bit of the Gray Report as well. In 2022 at Gray Capital, our total transaction volume, which includes acquisitions, recaps, sales, and refinances. So it's a big bucket, but total transaction volume for Gray Capital is $340 million.
Yeah.
So we were busy.
Yeah.
This year.
I've noticed. I noticed. Personally, it was busier. We did more things. Like I don't want to say like 3 times as busy as the year before, but it certainly felt like it.
You know, so in 2021, which was a crazy year, we bought about call it mid $30 million in multifamily. We tried to buy like $250 million in multifamily, and people kept just bidding things up to an amount that just didn't make any sense, and we were like, we have to stay with the idea of like, okay, we can speculate there's gonna be a lot of growth, and there was a lot of growth, there still is, but we still have to like be comfortable, but like, what if that doesn't happen? And so we didn't get to the price on a lot of deals. We bought some really good deals, but then this year, you know, we kind of took advantage of some of the, I think, the fear in the market of some people kind of getting out of the market, being pencils down, not sure what to do. We just took a little bit more conservative approach, but we also launched the Gray Fund back in February, which was a big game changer to the firm. It allowed us a lot more flexibility. We were able to move quicker. It opened up a lot of doors from broker relationships and owners that wanted to work with us because they're like, we know that you guys can close, we can get this done. And then, we went from $30 million last year to in acquisitions this year, $157 million. Yeah. Sold a lot as well, about a little just under $80 million in sales. We recapped about $55 million. Those are mostly co-GP deals. And then we did a big refinance of Villas on Fur, $52 million refinance. We locked in like a 2.7 rate back in just January of 2022. And so that's a lot to be thankful for. A lot of people that we've got to express our gratitude.
For sure.
You know, the whole team, you know, investors, partners, brokers, lenders, insurance folk. And then on the, you know, Gray Report side, Matt, you know, the Gray Report moved from just a YouTube show and a newsletter to a podcast as well. And I don't have the podcast data pulled up. I guess I could have done that, but just on the YouTube show. And again, like, you know, we're not getting like millions of views every day or anything, but, you know, we got about 15,000 views this year. So that's some major progress. We added about a couple hundred subscribers, which is always good. And we want to continue to add to that. And we appreciate everybody who's a subscriber, who is a consistent viewer of the Gray Report. Couldn't have been doing this without you. And One of the coolest things about doing this, I think it's fun. I think we're providing a service to people that are in the industry trying to learn more. But again, wasn't the purpose of this. Because we were trying to do this work for ourselves, and we're like, well, why don't we just do it for everybody? I think that makes sense. There's not a great source of this type of information and analysis that's like on more industry market specific, not like how do you do it, which that's fun too, but that's not our niche. But we've started doing deals with people who have discovered us through the YouTube show. We've had people find us on YouTube and get in touch with us and invest in the fund, and we knew that maybe was a possibility, but to see it happen is really cool. Because again, we're getting 100, 150 views per Gray Report episode on YouTube. We'd love to get that up. Share and like and turn it around to your network would be awesome. But it adds up as we're doing this once a week, in addition to some other videos. But to actually get people to get in touch with us saying, hey, I heard what you guys said and like what you're doing, and
we got regular viewers. Listen, I don't care. I'd love it if we had millions of views. But
we don't need millions.
But I do think that we have, we've sharpened what we're covering. We're really always continuing to improve our stuff, and I'm not gonna doom and gloom it every time. I may add some volcanoes in thumbnails just to get some people's attention. But I want to distinguish ourselves by offering as accurate a take on the multifamily market as possible, and one that's not kind of swaying to the breeze of whatever's happening.
Oh yeah, we could do comments I think are a little sexier, that are more like emotionally driven. But this is a little bit more black and white, and I think it's kind of more like eating your Wheaties than cereal, sugary cereal. But just top videos, Matt. And I know this wasn't even in our plan for today, but might as well approach the new year. Top videos on the Gray Capital YouTube channel in 2022. Our cap rate video continues to be very popular. And because people want to know they want to understand cap rates and interest rates, and I don't even think it's the best cap rate and interest rate video. I think we're going to do another one, but it's been pretty popular. And then everyone wants to learn about the Gray Fund. That's awesome. The housing affordability crisis. Number 3, commercial real estate inflation. That's more of global educational video, popular. And then also one of the first few videos that we did back in May of 2020. If you want to see a low-quality video, check out number 5 on the most viewed YouTube, on the Gray Capital YouTube channel, how to co-GP your first multifamily deal. And we get a lot of people reach out to us because of that video. They want to learn more about co-GPing. We don't do as many co-GPs anymore. People reach out to us, and they're like, hey, can we co-GP with you? It's always a possibility, but sometimes it's hard to fit into our model. And it can take a longer process for us to make that work, but we're always open to it. But appreciate everyone watching these videos, giving us support, and gives us the indication to keep doing what we're doing. Otherwise, we would still do this work, but maybe
wouldn't feel as good.
Would not feel as good. So that all being said, Matt, let's jump right into the reports today. Starting with this apartment list report, they're talking about 3 national trends for multifamily.
9. We got 9 total actually.
Okay, perfect. So 9 trends from apartment list. Trying to look into the future through the looking glass, and through the looking glass, I think is an alternative universe. So looking through the crystal ball on 2023. Matt, break it down for us.
Yeah, so Apartment List identified 9 trends, but and this was actually part of last week's email newsletter, but I wanted to comment on it here because I want to spend a little bit of time discussing what we think, what kind of you and I think are the most impactful trends for 2022.
So this is a good primer.
Yeah, exactly. It's a good jumping off point, and we'll list the trends here in a second, but I did want to spend some time speaking with you, and you can jump in and correct me as I list some of what I think is
let's see
the biggest trends, and this was just off the top of my head as I was making these notes, so I'll start. So I think number 1 is in this is another important point, is the apartment list trends are from the perspective largely of renters, maybe a little bit of investor folk, but their audience is a lot broader than multifamily investors. So when I was coming up with my own list, I thought of, what's my world is kind of multifamily investing and is a little bit more concerned with those issues. So number one, interest rates. I think it's the easiest one. That I think is the biggest trend for 2022. They started low, ended up high. The biggest run up in the federal funds rate in decades. And I really think it's so easy to put this one on top, other than the fact that we and every other economist has been talking up every bump in the road of interest rates for the whole year. But to oversimplify, the importance of interest rates for the multifamily investment market, higher interest rates means that loans to buy apartment buildings more expensive, which means that buyers' return projections go down. And that means that buyers are going to say no to higher prices because they need to hit those returns. And then that means that sellers are going to have to lower their prices because buyers are not biting on their prices. I think the same thing in certain ways is happening in the single family market, but affordability instead of returns. Because the interest rate issue has such a direct link to multifamily returns, and it has real effects on housing and the economy in general, it's not a real shocker to say that this was a major trend in 2022. And I think it's a very 2022 trend, and not something, hopefully, this is wishful thinking, that's going to happen or continue in 2023. The projections, and we can go on the dot plot that I'll have linked in the notes, but the projections don't have it much higher than 5.25. Some real hawkish dots are up near 6, but most of them, I don't think we're going to see another run up. This was a purely 2022 phenomenon, and I don't think it's something that we'll see for years to come.
Yeah, well, I think that's the most important and probably the biggest factor that investors are focusing on right now is, and it has been for a while, but interest rates. And the big difference and the big change for comparing 2022 to 2023 is hopefully some plateauing and stabilization of those rates. And I think it's going to be an end of hibernation a lot of buyers, and the market is going to finally thaw, and there's going to be more price discovery because you can plan. Again, to do a deal starting back in April and March, you had no idea where your interest rate was going to be when you'd close. Yeah. And so that just made it the risk profile of transacting incredibly high. And it was very difficult. We did it twice, or we've done it 3 times. Sorry. Technically 4, I guess, this year. Yeah. And we've been able to navigate. I guess one very early in the year as a Co-GP, Club Meridian, Stony Brook, and Sycamore. And none of those were easy, and there were a lot of kind of nail biting moments throughout the process. But that was all driven because of volatility, and the 10-year just ran, and loan proceeds just got taken away and destroyed, and return profiles, and so you have to either pull out of the deal or renegotiate, and none of that's ever fun. But if rates plateau, and just to your point, if we look at the dot plot and what people are saying, not that things haven't changed and will change, but we're looking at a terminal Fed funds and SOFR, in the 5 to mid 5s. But it's probably not going to go much beyond that, or that's at least conventional wisdom. Yeah. And so that allows you to plan a little bit more. Because, like, for example, and it opens up strategies as well, and ways you can execute. For example, we stopped doing bridge loans this year because we're like, well, starting at a 3.5% rate sounds attractive, but it could get to 7%, and the pricing is based on the 3.5% rate, and the cap rates are still low. Well, now cap rates have expanded a little bit. The prices are a little bit more favorable. There's still some gap, but deals are definitely popping up that pencil. But now, instead of being like, oh, I hate to assume a 6 or 7% interest rate, because that just seems, it just like it hurt to do. It hurt to plug into your model for a period of time. Yeah. But now it's like, this is what it is. And you had to do that. But now all of a sudden it's like, okay, well, we feel more comfortable that, SOFR is going to be in a range of, kind of 5.5%. That allows you to maybe take out a bridge loan that gives you more flexibility on an exit, that allows you to, finance the renovation of an asset. And we are seeing tired owners and a lot of it's institutional owners that are getting tired, that don't have the right management. You'd think that these big companies like REITs would be like good at managing the properties, and there's some that are, but there are also that are they're institutionalized to a point where, you know, for lack of better terms, like the soul has been the soul has been removed, and they are functioning. These assets are being managed, but just barely.
Yeah,
like they are barely functioning, and so we're seeing a lot of opportunity for just we're joking. It's like, I mean, yeah, we're gonna really manage it and actively manage it, but like just any sort of actual management would be an improvement from no management, no oversight.
Yeah.
So there's a lot of operational opportunities from tired sellers of some high quality assets, and I also think as growth is slowing, I think we're going to see I think we're going to see growth above 2%, that we would see in previous years. I mean, like GDP growth and inflation. I think we're going to be in the 3 to 4% range. I think we're going to see some decent growth, but I think we may see some more value add opportunities come up of where some, I mean, not too old of vintage, but some assets that just the rents are still hundreds of dollars below where the rest of the market is right now, and there's some meat on the bone. So we're seeing some opportunities come up. End of 2023, I think, is when the most opportunities will be coming available. But I think that we're going to see so many buyers coming back into the market that it's going to keep prices relatively high. That being said, and I was thinking about this last night, where everything in 21 was trading for call it 3.5 to 4.5% cap rate range. I think we're going to be reverting back to cap rates of several years ago, of where only assets on primary markets, trophy assets on the coasts are going to be trading for anywhere in the 4% range. Yeah. Like there will be some, but like they're not going to be, they're going to be no leverage, low cash flow deals that big institutions are parking money in. Those probably still trade in the 4 cap range. A premium deal in a good market would probably be in the 5 cap range. A B class deal or something in a non-premium market is going to be in the, I think, 6.5 range. And I think something that's, real true workforce, C class, it's going to be back into the 7 cap range. So I think we're going to be seeing 5s, 6s, and 7s, maybe even a little bit of a wider spread versus everything trading for 4.5 or so. Yeah. And I could be wrong. It could be more compressed than that, but we've already bought an asset for a mid-6 cap. A nice quality deal this year. Yeah. So it's definitely possible, and it's all relative to interest rates. Again, like if interest rates are staying around 5%, which is basically the long-term average of interest rates, so like we've reverted to the mean, there's cap rates need to be in some relation to interest rates, because there's other opportunities for income. I mean, real estate is a growth and income investment vehicle, but it's often looked at as an income producing vehicle. And if you look at other types of fixed income alternatives, there's other options out there that are yielding much more than multifamily right now. The risk profiles may be different. You may not be as comfortable with it. They may not have the tax benefits. You may not have the equity kind of upside growth potential. But, I was just having a conversation with a venture debt fund today, and they're paying 16 to 19% cash on cash. Yeah, yeah. Now it's a different. It's really good. Other private credit 9%. Municipals 6%. So, again, different risk profiles. Some higher, some lower. Your debt versus equity. So the different areas of capital stack, but not as much upside. But you can't get away. But it's hard to justify 4% cap rate deal on a multifamily in a okay market. Yeah. When you can go out and buy something that's yielding double that. Yeah, so that all ties back. It really does tie back to interest rates. It's changing the alternatives that are available, or the priority, the value of these alternatives to maybe multifamily. It's changing the multifamily market itself. And I think what you noted too was the fact that it is moving. It was a moving target in 2022. If it was just high, interest rates would still be important, but it would change the character of the market, change the kind of actions that have to happen in the market, and eliminate a lot
lot of those awkward conversations that you're having as the interest rates are changing. So being able to predict things is super great. Even if times are bad, being able to predict what's next is a lot better than times are bad and uncertain.
Well, it's like, okay, if you've ever done any sort of like target shooting or shooting, the difference between shooting a stationary target and a moving target. Moving target, there's a lot more variables that you have to take into account, or landing an aircraft on a moving runway or on an aircraft carrier. It's both can be done. They both require different set of skills and fortitude and exactly. But the risk is a lot different. Especially the way how you do it. So so interest rates. I think
that's
so. So no, I think that's what's on everybody's mind. Normalization, maybe lower interest rates near the end of next year. I don't know how much lower. I think a lot of that's going to be whether we have a recession or not. But what's next?
Okay,
2023.
So the next thing that I put on here is inflation. I think for multifamily investors, a major concern about inflation is that the Fed could raise interest rates. It's the ancillary effects, which kind of has already happened. But inflation also continues to make apartment operating costs high, whether it's in the form of increased utility bills, more expensive materials, and wages too. But I think that for the economy, inflation is arguably a scarier prospect than higher interest rates, because if I can, again, remain in wishful thinking mode without cracking a smile, the federal funds rate is determined by a set of reasonable people at the Federal Reserve who could see a big economic downturn coming, and then they could juice the economy with lower interest rates. With inflation, there's a fear that an unreasonable expectation of higher prices will lead people to push for higher wages, which really is not an outlandish demand, given the relatively tight job market. So it's a potentiality. And then companies will raise prices to accommodate higher wages. Then it circles back to people pushing for even higher wages, and so on. So that's the wage price spiral. As a multifamily investor, in many cases, inflation is not nearly as impactful, like I said, as higher interest rates, and sometimes can even lead to higher valuations of apartment assets. And the specter of extreme, even so, I'm sorry, inflation does affect the buying power of renters. And an inflation triggering. Recession triggering inflation could really screw things up for the entire economy, not only multifamily. So there is a broader economic worry about inflation, but I think that kind of the direct causal worry of most investors is interest rates, even though, inflation's in the background as this kind of specter.
Well, they're obviously so tied to each other, and I think that everyone thinks that we're going to be in a relatively higher growth environment with relatively higher inflation than the 2010s through the pandemic, for a number of factors, whether it's the onshoring that's going on, the energy transition, fossil fuels to alternatives, or cold fusion or whatever. That's makes things more expensive in the near term. Those are all inflationary factors. But does that mean we're going to be at 7% inflation, or is it going to be like 3 to 4% in more of a normalization? And I mean, it's the same. It's absolutely tied to interest rates, obviously, and then your point of the potential recession. I mean, that's going to be the one event that could really change the direction of interest rates, inflation, and the economy. But it seems as though you listen to the pundits and smart people that are talking about it and talking their book on the financial networks and are writing articles. Much more discussion of a potential soft landing and softer recession than necessarily deep and dark and hard. I don't think anybody really knows. I mean, the consumer continues to be confident. This holiday season, consumer spending was up. People are still buying stuff regardless of inflation. So the inflation doesn't seem to be materially impacting the consumer in a greatly negative way. But depending on if and when, which most people would say the probability of recession is quite high, does that put a lot of people out of jobs in a sense that it really sets the economy back, or in the long run, is that a better thing because we have such a tight labor market right now, and we need to kind of let some of the steam out.
Yeah, I think that some of the solution to inflation is going to be pain, whether it's job loss, lower wages, or anything like that. That is part of the bargain. But I also think that there are signs that inflation is not as scary of a prospect as it was.
Yeah.
And that's one of the reasons why I put it a little lower, and it's not as much of an obvious inclusion as interest rates, because if you look at certain graphs with certain metrics, it peaked months ago. It's still quite high, and
but like an annualized rate, like people were talking year over year, still like 7 or 8%, but like annualized we're at like 3.
Yeah. So we're not going like we were, and when it really peaked was like in like mid-year, and so
July.
ever since the monthly decreases have been increases have been a lot less than they were before, but still a lot. I think one of the unsung things, and people will hopefully start talking about this, they're talking about in the multifamily market, that's for sure, is rents and housing prices have not yet been recorded. The cool down of those two have not yet been recorded in things like the CPI.
Exactly. And we've talked about that on, go back and watch the last group report episode. We did a really good deep dive on that. But yeah, and once that finally shows up in the CPI prints, I think that we may see a final maybe capitulation of like, okay, the housing market has started to cool officially, which Jerome Powell went out and said basically they're trying to bring the housing market down because it had risen too much. Maybe I think that at least a pausing. The reversal, I think the idea and the plan is to pause and be at a plateau for a period of time that really brings inflation in check. Because we do have to remind ourselves that prior to the pandemic, we didn't want a recession, but central banks around the world were hoping and dreaming for a little bit of inflation.
Yeah.
I mean, Japan really needs some inflation, and they're finally getting it. The U.S. is finally getting it, and I still do believe, even I just mentioned onshoring and energy transition and all these factors that are inflationary, but there are still major forces that are deflationary that over the long term, I think that are going to be larger forces than some of these like transient events that are inflationary. Not these transient inflationary, but like they are just transients that maybe hold over for a longer period of time. And I think that's where, the Federal Reserve and Jerome Powell, and their talk of, this is a transient event, they were wrong in a sense of what you would typically think of as transitory in the way that they were talking about transitory of like a couple months or a year. I think it is transitory, but the period is not 6 months to a year. Maybe it's like a couple years.
Yeah, it's more of like a flywheel. It's like, boom. It just keeps going, and then it's got to come down and spin its energy.
But over the time, it may be a really good thing for the economy because we did have this like push of growth that allowed us to not be as deflationary. But I mean, again, they get this fusion energy turned on in a decade or two, and energy is near free. That's not inflationary.
And even just if you oversimplify it, we're for the onshoring stuff, we're building the factories, we're building the super new fusion reactors now. That's going to cost money, and then maybe 10 years from now, things are going to get a little cheaper. So
I just don't underplay the deflationary forces of technology. I mean, we were talking about AI and ChatGPT. Don't tell me that that's not going to make us more productive and make things cheaper to do. And we don't know what the next piece of technology is that's going to be a game changer in terms of productivity and making things cheaper and easier and more convenient. But I think that over the long term, we're going to kind of, and I could be completely wrong. Maybe we're in a completely different trajectory, but again, aging population, the growth of technology. I see us eventually, could be 20 years, but reverting back to that trend.
I completely agree. I think that short term, you have to have a short term mindset, otherwise you're not gonna make it to long term. But long term, those are very real, especially considering some of the demographic shifts that we're seeing.
And I mean, it's developing societies, typically less volatile. I mean, but the trend, it's been going on and we did a whole video on this. It's been going on for hundreds of years, if not 1,000 years,
Yeah.
this trend on like lower rates. But people are like, we'll look at the 70s. Well, 70s were an anomaly and another, I'd say, transient event that was caused by kind of external forces that stuck around with us for a decade or a little bit longer.
Yeah.
But then we continued that trend down, and so this is another one of these moments. And so again, that's where I think it's exciting for investing in real assets that are typically prices go up in inflation, but with a lower growth, lower inflation, those rates go low and the valuations can go up quite a bit as well. And so if you can kind of buy in one type of economy where you can buy assets at attractive valuations that produce great cash flow, and then sell it in an environment that is more growth focused and lower rates, less cash flows for the buyers, but higher exit for the owners.
Yeah.
I think that's what we're setting ourselves up for right now is it's going to be more cash flow. Again, we talked about higher cap rates because of higher interest rates, probably some higher rent growth. But then eventually that reverts back. The economy gets a little bit more mature and rates, start getting, lower and lower and lower. And cap rates will probably come down in lockstep. But again, 3 years, 5 years, 7 years, 10 years, I don't know. But I would plan for that longer term horizon just in case.
Yeah, I completely agree. And that's a nice way to kind of cap off the issue. And there's something that you mentioned a little bit, and it does relate to interest rates and inflation. Is the next factor that I pulled out is the single family home market and the softening of home prices. Rent growth was huge in 2021 and early 2022, but price growth for single family homes was enormous. Mm-hmm. A lot more. You can see the charts of that just show how much, and I don't have them on. I don't have them on a link, but I'll provide it in the show notes. Home prices outstripped rent growth by an enormous factor. I think that high mortgage rates maybe have driven some people into the rental market at the margins, but it's more useful, I think, to think about sinking single-family home prices as a product of lower housing demand and lower household formation, which fell from 1.5 year-over-year growth in Q2 to 0.96 by September. It fell really quickly in a short amount of time. That may or may not be, a direct effect of interest rates, or maybe a bounce back from previous highs. But that's just this year's growth, and you can, and it's almost hard to see because of the chart is so expanded from like the 70s that we have on display here. But there's a short spike downward close to the end, and that's where that's kind of where we're living right now is this downturn in household formation. I think that there still is a housing supply problem, but the single-family home price softening is something that really started happening in 2022. Seemed almost impossible. It seems they still are stubbornly high, and I think that this is a trend in 2022 that is worth mentioning, also because I think it will extend into 2023.
Well, the question we've been asking ourselves, Matt, is how much demand was borrowed from the future in 2021 of where people were just making big decisions. They're buying houses, moving around, create a lot of demand. There's a lot of mobility. Even the retention rates went up, which created the situation where rents are rising because there wasn't a lot of availability. Yeah. Occupancy was very high, to where all of a sudden we have a pending recession and people have already made big decisions. They've got some decision fatigue, but also just people don't make decisions in an uncertain environment, and so demand just fell off. Yeah. Completely lowest demand in decades. So the question is, is demand being pent up because people are putting off these decisions? Is it being pent up for sometime in 2023? I think as late as 2024, but I think we're going to see a slow start to 2023, but I think it's going to pick back up kind of middle of the year, barring we have a blockbuster recession that cools things again. Yeah. But people in the pandemic, it was a recession and people were losing their jobs, and the market just took off.
Yeah.
So weirder things have happened. And I don't think that this recession is going to be like your typical recession. I don't know what that even means. But like, what do we call this last year? I mean, I guess stagflation. I mean, stagflation. We've had growth lowering with inflation. It's stagflation, but it's technically not a recession. We had 2 negative quarters of negative GDP growth, but it's not a recession for some technical reasons.
Maybe it's a tropical depression.
Yeah, that's what it feels like. It's like, okay, it's not a hurricane, but like it could be any day.
Yeah.
That's a really good way to describe it. But like, this hasn't been a good year. You know, the stock market's down 20%. You know, values of every asset class are way down.
Yeah.
But I think everyone just has a sense like we haven't gone through the appropriate amount of pain.
And I think that there is a strange lingering optimism after a great recession that was extended so long, and people's attitudes were so horrible.
In reference to like 2008 or
from 2008 to like 2018 almost. That's like 10 years where people were not thinking.
Yeah, people were still had hangover from 2008 in 2018.
Yeah.
People were starting to get over it.
And we're still starting to get over it.
Yeah.
I think that one of the big things for the single family home market is it goes back to interest rates. It is they're paying for less their mortgage. They're paying for less home than they could. And that has dampened prices. I think, again, another thing that gives me a little bit of pause and makes me think that maybe the home prices still have some room to fall is that housing sentiment is still very low. The buyers are not buying necessarily. The sellers aren't budging yet because they don't want to sell, because then they're going to have to buy a new one at higher interest rates. So maybe something won't give, but if it does give, then we've got a little bit more price drops to see in single family home prices in 2023.
He's right. I mean, there's still not a lot of inventory.
Yeah.
So people who need to sell, the prices are coming down because people can only afford to pay so much. But at the same time, you have investors of single family homes that are, all of a sudden, hey, if it cash flows, if I can pencil it, I'll start picking up. So there's a lot of buyers for single family homes, and the demand is there. And I know there's a ton of buyers who were just on the sidelines waiting for it to make sense. And they don't necessarily care as much about their interest rate as but to your point, what they can afford and, the amount of space that they have and what can they get.
Yeah.
I think that is going to lead to more renting in the short term. But I don't see like a recipe for the market to fall out.
Yeah.
I see opportunity for a very appropriate and healthy correction and a little bit of a mean reversion. Because it's okay. So homes were up 30 to 40%. Well, now they're going to come down 20 to 30%, and so they're up 10. They're still up quite a bit.
There's still a bedrock of demand.
Yeah, and I think that'll be in the extreme, some of the more volatile markets that have saw some of the bigger swings, like maybe your Tampa, your Phoenix, Nashville, Atlanta.
Getting a couple more things, and those are the last two items. But first, I did want to note, along with the single-family home market softening, yes, rent growth has normalized. We've had an incredible amount of rent growth, really from kind of late 2020 to early 2022. Clearly started to slow down in 2022. And the phrase reversion to the mean is an abstract term that maybe shows what it looks like.
It isn't.
Yeah. It shows what it looks like.
Abstract, but it's also you can also plug it into my Excel model.
Yeah. You can see what it looks like mathematically, but it doesn't really explain the reasons why there's a reversion to the mean. And I can speculate
if this is not a reversion of the mean in household demand, what is? Mm-hmm. Look at these periods, and bam, right there in the center.
Yeah, I think that does explain kind of what is happening. But in terms of observable reasons why this normalization and this reversion is happening, I think, pressure from interest rates, renters, but also this very simplified idea that renters before were willing to pay a certain amount of rent, and they've reached a ceiling. I think inflation has a lot to do with it. There's higher expense costs, and it raised rents outpaced wages for a certain amount of time, and now they are just reaching that ceiling.
It's the fatigue.
Mm-hmm.
Yeah.
And so this could be really seen as a natural market force where rents are reaching this point, and the party is a little bit over. But that and also in saying that, it was a very crazy,
because
hyperactive
people,
party.
what led to that was, okay, well, we're 100% occupied. Mm-hmm. So we should raise our rents because there's obviously this much demand. And so you raise your rents, I don't know, let's raise them $50 a month. Okay, well, that seems like a lot, but let's do it. And then that unit comes up, it gets leased right away.
Yeah.
Okay, the next one will raise it another 50. There's no way, it's too high. Then it gets leased up right away. Mm-hmm. And so you keep thinking that you're in the ceiling. You're like, well, let's try again. We're still 100% occupied. You know, we only have one unit available. And people keep signing leases for more and more and more. And you're just, if someone didn't sign the lease, you'd say, all right, let's keep it where it was, mm-hmm. Or let's bring it back down. Let's find right where the market is. And so that led to people kept pushing and pushing and pushing. And then even when the music kind of was slowing down and stopping, people were still kind of catching up. Because a lot of people didn't move to the market back in end of 20 and through 21. So they're mm-hmm. playing this catch up. But then all of a sudden they found themselves in an environment where demand had, like, the spigot had just been turned off. Yeah. And it's not working. And so now they're having to bring back their rents back in line, something a little bit more reasonable. Yeah.
The lights went off.
Yeah. Because occupancies are no longer, as nearly as tight. We're back to more historical averages in terms of occupancy. Mm-hmm. We usually are, as a nation, each market is different. It's, around 94 to 95. But, we were at like 97 nationally. Yeah. That's a lot.
Yeah. And I think normalization is a really accurate term here, because it's not like we're getting into a dangerous spot. We're still, in terms of like vacancy, we're doing great.
It's good. Yeah.
Which does kind of lead to, and I'm going to skip over one for a second. Well, no. I want to cover this Midwestern stability. Yeah. Because I
was wondering if you were going to mention this bullet point here for key regional trends.
So it does definitely talk. So what I was thinking about does share a lot of commentary with the apartment list trends that they also identified. Specifically, the idea of Midwestern stability, how the Sunbelt superstars didn't do so well in 2022. The big standouts for year-over-year rent growth are in the Midwest in a lot of cases. But they also talked about this idea of price convergence, where some of the high-flying markets, the rent growth is not as strong as some of the more affordable cities like your Indianapolis or Columbus or Kansas City. And that seems to be a really good argument for the idea that people have a price ceiling, and some places have reached it and overshot it, maybe like Phoenix, and some places are still kind of pointing towards it, like Kansas City and Indianapolis. So that's,
I mean, if there's, I don't know, a better tortoise and hare like analogy that's out there between the Midwest and the Sun Belt.
Yeah. And so, and actually, we had Noah Stone on talking about volatility in some of these. There's some upside volatility, there's some downside volatility. It's just a little bit more unexpected in some of those Sun Belt markets, and they're a little bit on the downside this year. That's not to say that they can bounce right back up in 2023.
Well, in the same graph that we just showed, I mean, they're down this year, but they had incredible years in 2021. I mean, really strong. I mean, broke records. Whereas a lot of the Midwestern markets, they were strong years, but they weren't. They didn't even hit the national average according to apartment list. But they are still growing, whereas these other high flying markets are retracting this year. And that's what we saw. And again, this is same song, same dance. I mean, 2008 it was the same markets. And a few more that had grown incredibly, and then they all just dropped off. They fell off. Now they came back, and people made a lot of money. People lost a lot of money. People made money, then they lost money, and people made more money, and now people are losing money again. Whereas in the Midwest, not that people don't lose money. There's always risk. But it's much more consistent. And at least from like my perspective, it's just we're consistently making money, which is I like, and I can
That's
predict
a good kind of consistent.
It's a good kind of consistency. Because again, I don't like, and this is why I stopped flipping houses. I don't like the musical chairs of trying to get the last seat before the music stops, or the last boat off the Titanic. That just I've got 3 kids. I want to be able to like sleep well at night and not have to worry about, someone coming in and dropping in 10,000 units in my little submarket. So if someone comes drops 1,000 units in Indianapolis, no big deal. But,
Yeah, I agree. And finally, so and I don't want to downplay this last trend that I've kind of identified more than any others, but but only because it's less prominent this year in my list. Am I talking about it last? But the housing supply and demand imbalance has persisted despite rent normalization or housing price cooling off. There is still not enough homes, and demand for those homes is still high.
But Matt, what do you mean? There's over 1 million apartments under construction today.
Under construction is a great way to say not finished,
not available.
And the problems that we've had with construction and timelines getting extended, they still persist. I think that probably they're being solved now.
Yeah.
But expensive materials and expensive labor costs, they're not all gone, and that means that some of these projects are gonna be maybe 1 or 2 years longer than they could be.
Or some, I think some of them are going to get scrapped too, because I think they're going to look at their new pro formas and they're going to say, guys, this deal doesn't pencil anymore. We can't build this. I think that there will be some cost saving measures, especially if there is a recession, maybe, the cost of labor comes down, or at least it's more available. I think part of the problem is you just couldn't get scheduled, with your builder or whoever, or your subs. But if, maybe they become more available. We shall see. Maybe it's an opportunity to build, but under construction doesn't mean delivered. Yeah. And those times have been pushed out further and further because of all those reasons. Yeah. We need the new supply.
We'll be talking about a couple of these sources that talk about all the regulatory hurdles for new housing and how people are increasingly talking about let's clear them out. So we'll see if government kind of solves this problem.
It makes them feel really warm and fuzzy.
Yeah. But just to really fly through the 9 trends that Apartment List identifies, and some of them are very similar to the ones that we just talked about. They talk about rent growth coming back to earth and more options for renters really kind of as a renter's market, and a lack of household formation driving demand for apartments lower. We also mentioned that. Sunbelt down, Midwest up. That's another trend. And the idea of early pandemic price convergence still happening. That's a big deal, and I think it's particularly interesting for this idea of a price ceiling that maybe people are reacting to. One thing that I didn't mention is the suburban boom. Suburban apartments, suburban offices really too, are doing a lot better than the ones in the central business districts. So we'll see kind of how that is. We've talked a lot about how there are these outer ring suburban cities that are popping up. Some real interesting development that is happening, and some growth happening in these outer rings. Next, they re-mention. I feel like the renters back in the driver's seat. They already said that.
How many driver's seats can they drive? How many cars they have?
Yeah, that's right. One thing they didn't talk about, we didn't mention, was remote work. They say remote work faces its biggest test in 2023. It's still maybe up in the air how much we will have continued remote working policies.
It's hybrid. Everyone's agreed hybrid.
Yeah. I think that, it did jump up during the pandemic, and it's not going to go down all the way to back to normal. There's where people will still.
Yep. Pandora's box.
And then finally, they say that we'll finally see cooling housing market show up in 2023 inflation measurements. I think so too. And that has the potential to have some real serious effects on maybe the Fed will make some movements. Maybe people's attitudes will change towards inflation. They'll be less fearful, and that could encourage more economic activity. Who knows?
Is this a national rent index or indes?
Oh, it's an index. Maybe it's like
indies. Indies, plural for indexes.
I think that's what they're
indexes.
So that's a small typo that we're referencing for the podcast listeners. They do not spell index; they spell INDES and not X.
Just trying to keep.
We're going to assume that that's a typo.
Yeah. Good stuff. All right, Matt. now everyone knows what apartment list and we are looking at for 2023. What do we got next? Want to move on to this Berkadia piece?
Yes. So, there's problems with housing and some people are doing something about it. And some people are finding problems or creating problems, perhaps, arguably, that weren't there before. I'm neither here nor there. I do not take a specific policy position. I take a policy suggestion for when it comes to rent control, but there are a lot of places that in 2021 and 2022 enacted some restrictive housing policies, let's just say. And just to skim through, and then I will kind of comment on their position, on the position of the NMHC and the National Apartment Association on these rent control provisions. In California, voters approved to limit rent increases to 75% of the CPI. And they also lowered annual rent increases from 6 to 3% in Santa Monica. And in Richmond, which is a city north of Oakland, rent increases were limited to 3%. Okay, so that's California. In Maine, tenants' rights measure was approved, which limits annual rent increases to 70% of CPI, and a 90-day notice for lease termination, restrictions of security deposits to amount of 1 month's rent, and a prohibition on fees for applications, credit reports, and background checks. In Florida, there is in Orange County, which is the Orlando MSA, they have a planned ordinance which would prevent existing apartment owners from raising rents at a rate higher than the inflation rate for the region over the next year.
For new development or just in general?
I don't know the specifics. They didn't name the specific, whether it was new development or not.
You can't raise rents over inflation? CPI, that's the idea.
That seems like it, yes. Now, the Florida
that sounds like an idea a politician made up. Like, it makes sense, right? We'll just peg rents to inflation. That'll make housing work.
Well, that idea and Florida, that's not going to.
That's the whole reason why we were building and investing in housing, is to outpace inflation. So we're just not going to build any more housing or invest in any more housing.
Yeah. Well, maybe they had the best intentions.
Yeah, clearly.
The Florida Apartment Association. So notice I said planned ordinance and not enacted.
Yeah.
Because
what does that mean?
The Florida Apartment Association and the Florida Association of Realtors filed a lawsuit before the election to get the measure off the ballot, and the judge ruled that the suit could not proceed until after the election. Well, nearly 60% of voters approved the rent control ordinance, yet pending litigation has stopped the ordinance from going into effect. I think there's going to be continued opposition. We'll see how that plays out. I don't anticipate it going through, at least in this form. It's going to be drawn out.
But either way, whether it doesn't go through or it actually, if it doesn't go through, it's pretty close. Mm-hmm. And Orlando is different than the rest of Florida. But still, I mean, Florida's now a relatively conservative state. I mean, it's been purple for a long time. But that's definitely if you can't raise, if any type of limit on rent increases is a reason not to invest. There could still be reasons to invest. I know people invest in rent controlled apartments in New York City, but it's like, well, they like it because no one ever moves out. Yeah. And if they do, you can raise the rents quite a bit. You're not raising your rents, but it's relatively low risk.
And that's exactly the reason I think that the National Apartment Association and the NMHC posit for why they don't work, why these rent control are counterproductive. They say that rent control exacerbates housing strategies, housing shortages. It causes buildings to deteriorate, stunts new development, and can potentially lead to higher rents. They point to the ill effects of Minneapolis-St. Paul market as evidence. As a result of rent control laws, about $1 billion in multifamily projects were either put on hold or canceled. There's also a map.
That's with a B, billion.
Yeah, and that's just in the Minneapolis-St. Paul area. We have seen Minneapolis rent. As its rent growth was anemic, probably because of its policies. One of the worst. But
I have to, between Minneapolis and San Francisco. I think Minneapolis is probably the worst performing market over the last few years.
Now, from a renter's perspective, though, that's great. Yeah, but if you look to the rent to income ratio, Minneapolis is not on the lower end.
Yeah, that's true. It was already expensive. And if you look at markets with rent control, it's not like there are cheap places to rent or to live.
Yeah.
and it's the concept of focusing on symptoms rather than core problems, and focusing on solutions. Just it's like they're scratching the itch and they're wondering why it's getting worse, not getting better.
And so this is one side of the argument, like you said, is like the kind of the Band-Aid side. And it is very attractive. It is very it seems reasonable from the perspective of a renter. Why I don't want my rent to raise? Why don't they just prevent it from being raised? And what I've seen and noticed in the past few years is an increasing amount of, this is kind of rent control is kind of on a more democratic issue, a more Democrat issue. And I've seen an increasing amount of voices from the Biden administration itself. We saw a memo earlier this year talking about housing supply. It's talking about maybe don't solve this with restrictive things like rent control.
They did not want, even in, President Biden's memo from the White House, it was not rent control. It was more deregulation.
It was don't restrict. Let's make things more open and expansive.
I mean, it seems like there's and we were talking about this just before the show. It's that the Democrats are relatively split between more the ideologues and some of the pragmatists, and then on the Republican side, it's really don't want to do anything at all. But you'd think that there would be a lot of bipartisan support, because we're talking about deregulation that's going to allow for more affordable housing. That can be a market-based solution that seemingly the White House is behind. Seems like it could be a win-win.
Yeah, I think that we probably are seeing it, not necessarily from Republicans, but maybe from groups that are majority Republican members. I'm guessing a lot of investors and developers of apartment buildings are Republican. Maybe some are Democrat, but some are Republican.
Sure, it's a mix. But
they're probably pro deregulation. And this, and we can even jump to this Wisconsin Institute for Law and Liberty. It seems like a more right leaning from the title of that alone. So this kind of leads us a little bit into this Wisconsin Institute for Law and Liberty piece, how laws and regulation add to housing prices in Wisconsin. They are, I am assuming, a more libertarian or right-leaning outfit.
That's what it kind of seems like.
And while this paper is limited to the state of Wisconsin, I'd say it's pretty representative, maybe even emblematic, of the difficulties in adding to housing supply and how that drives housing prices up. And a lot of the solutions are similar to another paper that we read earlier this year. I am blanking on I'll include the link in the show notes, but I'm blanking on the specific source. But it did delve into a lot of these obstacles to housing and the things that we could do maybe to overcome them. This is not the first discussion that we've had for sure, but it does offer a really great overview of all these things that not only are making it harder for poor investors and developers, but they're making housing prices bigger, and that happens to everybody. And so you don't want that. And so
it's tough, because some of the solutions will sometimes directly, sometimes indirectly benefit investors and wealthy landlords, which are not the most popular group for politicians to help out. Even though that many politicians got themselves among those groups and their donors, but you sometimes need that to also facilitate increasing housing supply and making a better housing situation for everyone. I mean, think of it this way: like, why would a developer or investor be able to create more housing or make a better situation for housing if they're making less money or they're being targeted?
There is a counterintuitive, from a certain perspective, there's a counterintuitive policy that will help these rich fat cats, but maybe help the poor average Joe even more. And it hurts to help the people that you hate, but sometimes. The problem is like, that's true, but it's the even more, because it's like the developers getting like so you build affordable housing, which is awesome, and then you're getting like a really nice development fee, which can be millions of dollars. Now, they took a lot of risk. There's a lot of reasons for that development fee and all the money that they're going to make, and again, 100% for it. But I guess the other side of the coin is, it's okay, we've got some housing that is relatively affordable, which we need, but the developer's still making millions of dollars, and that doesn't seem fair. Well, same thing I telling my 6-year-old
what life is not fair.
Yeah.
It's just I have to understand that it doesn't always work that way. Sometimes things are the way they are. And it's not always from our view the way things are in a perfect world. But we're not in a perfect world.
That kind of gets into the topic of there are also and maybe it seems unfair, but there's unintended consequences. You may when you try to make things fair, that could make things even worse. And what I want to mention is there's another source that maybe we'll get to if we have time, maybe not. It's well worth noting that the places with the highest homelessness rates are actually cities with great job markets.
Yeah.
Superstar cities like San Francisco. They're fueling these housing problems because of the enormous barriers to new housing that they're putting up. And one of the points in that article is that there are these cases where you might just barely be able to afford housing, and that's happening more and more, and that's happening even more in great job markets like San Francisco or Boston. It's because the cost is up, and it's widening it's widening these obstacles to get housing and to build housing, and it's creating a bigger problem because of some of the reasons and I'll go through right now. So back to Wisconsin. Here are some of these obstacles.
Yeah, let's look at some of the big highlights.
They're in Wisconsin, but they're everywhere.
Yeah, no, when I read through this is all I think be applied almost every market in the country.
So one is kind of too many regulations and hoops to jump through, whether it's testing, approvals, other rules, traffic tests, environmental things, lots of rules that need to be followed and specific methodologies. Maybe it's a test, but also maybe it's a technology, or maybe you have to do things the right way. That's going to be more expensive than otherwise.
And that's a tough one, because I was going through deeper down in this paper where they list of all the things you have to do before a development, and a lot. This is the challenge. The list of things that you have to do, a lot of the things you would say, it's probably a good thing that they're doing this list. Yeah. Not everyone. Okay, do we need to do 3 more environmental tests, or do we need to there are some hoops that are definitely burdensome that can be reduced. But again, that's the hard thing to sell to the public of we're going to loosen standards for building and developing. Yeah. And what's that result going to look like? That to me, that's a harder sell to the public than some of these others.
Yeah, that's true. And I was just talking to Addison earlier before. I was I don't want to live next to I don't want it to be so loose regulations where I'm living next to a building that's full of asbestos and is going to fall in on itself in 2 years. Yeah. That's a little bit different. And likewise, there's in recent news, we've kind of tracked this earlier last year and earlier this year, is that UC Santa Barbara dorm that's 91% of the students that would live there will live in a windowless room, and and it was just reviewed.
That was the Charlie Munger?
I think so.
Planned dorm. No windows.
And it was so they use the word prison in a lot. But there are regulations for a reason to maybe not make those conditions, and it may add to development costs, but I think that there still are some regulations that are a little bit overly burdensome. Yeah. Good intentions, but again, unintended consequences.
Yeah. And the market does have some functions to, combat against that, and, because no one's going to want to live usually unless you're forced to in a windowless place to live.
So, and then the final two, and they're still kind of rules, but they're different kinds of, and they're worth mentioning here, is rules against building denser housing, like minimum lot sizes.
Yeah, that's the one I wanted to talk about. And we've got a guest here, Doug Tuvok, who I think
he's probably in opposition to some of these
rules. He's really upset against NIMBYism. But the minimum lot size. And San Francisco actually did sort of touch on this in the sense they allowed for the ADUs, the auxiliary dwelling units, because it was why wouldn't we let someone build a mother-in-law unit in the back? They've got it. Why that's a no. It doesn't hurt anybody. But if you think about it, it's we could fit 2 or 3 units on here, or 1, or we could fit 10 or 1. And the fact that things aren't getting built because of just the city thinks that you shouldn't have more than 1 or 2 units on this piece of land. Yeah, it doesn't really make And it usually doesn't make a whole lot of sense.
Yeah. And related to that is this idea of NIMBYism and what they call hyper-local control and opposition to housing, because this maybe a neighborhood level control obstructs affordable housing and the exercise of property rights from people that maybe want to sell and subdivide their lot, or maybe build a duplex when they're not allowed to. There are pushes because the neighborhood doesn't want change. I think that there are pushes for people that don't maybe want affordable housing, but then maybe there's the gentrification opposition where they don't want their property taxes to raise. So it's just this resistance to change.
It's just change in general. Yeah, and I mean, it doesn't matter what it is. It's like we don't want that here. And the classic is I support affordable housing, I support development, but I don't support this.
Not here. In terms of solutions, this is they kind of. Again, like I am going to track down the paper that we covered earlier this year because it does have similar solutions and even gets into a detailed plan about one of the things. An interesting solution in that earlier paper was, maybe your property taxes are going to go up, but maybe we build this new apartment in exchange for a reduced property tax burden in the area for a certain amount of years. So maybe there are concessions. There are some creative solutions to this that might counter NIMBYism. Okay, so the solutions in the Wisconsin paper, however, they start with more by right zoning. By right zoning leads to the creation of community-wide standards instead of bless you. That was a dog sneezing. By right zoning leads to the creation of community-wide standards rather than hyper-local standards on what sort of building can and cannot be allowed. It limits the ability of these hyper-local groups to stymie new development or projects that are outside of their specific
their control,
purview.
their fiefdom, which is what they kind of become, is these little fiefdoms of people with not a whole lot of experience, and that they're the king, and they are the one that gets to give approval or not approval, and they don't want someone from the city, anywhere in the city, to come in and be able to build whatever they want, even they own the property. And a lot of this comes down to property rights, and are we going to support property rights or more just community-based, societal.
Yeah, and we've talked about there are another couple that they talk about, like the minimum lot sizes. Yes, that should be an easy. That's an easy one, and then another to kind of encourage more denser housing in general. But I thought what was interesting, one is create transparency in the process for approvals and rejections. The label of subjectivity and opacity in the municipal evaluations of individual development proposals leads to unpredictability and often the appearance of incompetence or impropriety. The appearance, that's a good way of saying
it is, but
setting clear standards on areas such as green space requirements and fees the developer will be subject to, that will work to streamline the process. That will work to, I think, dissuade someone that had a bad morning that just rejects a plan, because their mood's bad.
Yeah.
I think that this transparency will maybe it will lead to a reaction against some of the onerous rejections of plans, but also it will give some people pause and and say, okay, maybe I got to actually develop a consistent standard and stick to it.
Yeah, but so much of it is, if you know somebody can get it done, or but if they don't like you, you're not getting anything done.
And this is what I've heard, the neighborhood rejects you go above their head. If you have the pockets, then, and I have mentioned this before, but it is these communities that will reject the small kinds that won't make a big impact, that will change the neighborhood a little bit, but then a big time guy with a lot of lawyers and a lot of pull and a lot of money and a lot of patience will push through or go over their head, and suddenly you have a huge development that completely changes the character of the community. And it is because you've been focusing on the tiny little trees and you don't see the forest that's creeping up behind you.
Yeah. Matt, we're not going to be able to get to the Atlantic piece, but you can find it on the Gray Report. Make sure you're signed up for the Gray Report newsletter. You can go to grayreport.com. You can go to graycapitalllc.com. Two great places to go. And if you're not subscribed to the Gray Report on the Gray Capital YouTube channel, you got to do it. Subscribe. That way you're going to get every new video. Make sure you like and give a comment. We've been getting more comments, Matt, which is very exciting. very exciting. We really appreciate that you took the time, whether it's this episode or any other time during the year, to check out the Gray Capital YouTube channel, watch the Gray Report. We really appreciate it. We've got a lot of great things in store for next year, so stick around. Make sure you continue to be subscribed. Again, always, if you're a accredited investor interested in investing with Gray Capital, hop on over to gray.fund. Thanks for watching. Catch you on the next Gray Report.